you very much, Chair. Good afternoon to you and to the committee. Thanks for asking me to participate in this study of Bill C-330. I just offer 3 points by way of introduction. The first point concerns the context in which we find ourselves. The impact of COVID-19 on people and our economy has been massive. There will be some permanent damage. However, the damage has been mostly limited to sectors that have been shut down. In a typical recession, bad news in one sector usually infects the other sectors through lower confidence. And this has not happened this time. I think this is the main reason why the economy has significantly outperformed most forecasts during the past year. This economic strength has generated a debate around the appropriateness of fiscal stimulus. It has given the government far more fiscal room to maneuver than previously expected. However, any major economic trauma will scar the economy, and these scars will run deeper the longer it takes for the economy to heal. So scarring manifests itself as a level of national income that would be lower than it otherwise could be, literally forever. So I therefore subscribe to the view that it makes sense to push the economy harder during the early stages of recovery, because this will encourage business investment and create new economic growth. My second point concerns fiscal sustainability. A credible fiscal plan in which the level of government debt relative to national income stops rising and debt service costs are manageable, meets the minimum, or we should say perhaps technical, standard of sustainability. I draw your attention to the table on page 328 of the budget, which shows that these criteria are met. By the way, comparing this table to a similar one from the 2019 budget 2 years ago demonstrates that this budget does not represent a sharp turn toward big government, as many have said. The planned budgetary expenditure trend line returns to about 15% of national income, just as it was pre-COVID, and the budgetary revenue trend line does exactly the same. Now, there's a legitimate concern that this minimum standard of fiscal sustainability would leave the economy vulnerable to future shocks. Well, that issue is for a broader political debate, a debate that I think should acknowledge the challenging fiscal situation in our provinces. When we combine federal and provincial debt together, as we should when considering Canada's future resilience, our fiscal picture is not very different from that in other major economies. My third point is that there are many ways to build future resilience without government austerity or higher taxes. If we put our minds to it, we can grow out from under our COVID debt burden, just like we grew out from under our World War II debt when I was young. Now, there are many ways in which we could boost our long-term economic growth rate and grow our way out of our indebtedness. First of all, immigration is Canada's most important economic growth engine, just as it was in the 1950s and 1960s. So anything we can do to make that process more efficient will be a good investment in future growth. Second, a national child care program, as announced, can also help boost labor force growth, so I do hope that it can be deployed without delay. This is the sort of program that can literally pay for itself. If we can boost the level of national income by a mere 2% in this way, which amounts to $40 to $50 billion more national income every year, then $6 to $8 billion will automatically land in government coffers, also every year.
Mr. Poloz, I'll direct my questions towards you, and it's good to see you on committee again. And thank you for your presentation. Quantitative easing and the amount of stimulus that we've seen into the economy, I know when you had appeared previously that you had forecasted that inflation was in check and that it didn't appear to be an issue, but we're seeing some trends now that are quite concerning about inflation. Particularly, industry has suggested that because of supply chain issues, shipping issues, and we've seen it in very, very much in several sectors that we're starting to see that spike up. Is this not a concern both on two fronts, affordability in a variety of different sectors and competitiveness, And two, on the potential of interest rates now starting to rise to offset that inflation. And you're muted, I think, sir.
Muted, Stephen.
You're right. Sorry about that. You'd think by now I would have found that mute button. Here we go. Well, of course, inflation risk is something we can never take lightly. However, I would just add a couple of things to your premise there. One is that most of the anecdotal or evidence we have around higher prices is coming from commodity markets. Commodity prices, in fact, have been quite depressed for the last while. In fact, if we look at the CRB index of global commodity prices, they're just now returning to levels that they were at back in 2014. If you look at the Bank of Canada website, you'll see the commodity price index, and there too, all the basket of commodities relevant to Canada, prices have been low and now are returning. So this is not inflation. This is normalization of prices. Now, I know there are some exceptions, prices that have gone up a lot, such as lumber, I think is a good example. There's also still the laws of demand and supply still work. Last year, there were plenty of cutbacks in production because the consensus among a lot of economists was that the economy would be very slow for a very long time. And as I mentioned in my introductory remarks, the economy has bounced back, far exceeding all of those expectations, because economists have modeled it in the traditional way that recessions normally work. This one isn't like that at all. And so I think some sectors are still catching up to the recovery in demand. And inflation almost never comes from commodity prices, because commodities can always, you can find more product. You can expand capacity in time. So usually when prices go up enough, somebody brings more capacity online, and that causes that price to settle back down again. And so, I agree with what I've heard from various central banks, that, including our own, that the inflation that we're observing right now is very likely to be transitory.
Would you agree, though, that it's not just those commodities? We're seeing a significant spike in real estate, and certainly an inflationary run on the value of real estate in the country.
Well, the price of houses is a special item. It's as you know well, it's not just something we buy. It's an asset. It gives you a stream of housing services for literally forever. And so as a consequence, when interest rates are low, the price of all assets tend to rise, including the price of houses. It's also the laws of supply and demand have not been ruled out. We still have excess demand for new housing relative to the supply that's being created. I note the latest numbers show that housing starts are picking up strongly. And so they're just like with commodities. Supply can come on the market and meet that. I'm not going to pretend that the price of houses has not gone up. But that isn't, strictly speaking, in and of itself, inflation. As we describe it, it would need to be something that is sustained for a long period of time for it to be part of inflation. And of course, it is captured in various ways in StatsCan's Consumer Price Index.
So, Mr. Poloz, you had suggested in one of your points that economic growth is an opportunity to dig ourselves out of this hole. And I actually completely agree with that. But should not, two things. One is we've seen a decline in competitiveness for Canadian companies due to tax structure and probably in addition to some of these commodity prices. But also, should the focus not be, if there's going to be any kind of stimulus spending, on assets that will help produce revenue or improve competitiveness or improve innovation? Because certainly we have to be, according to your remarks, I think export focused rather than selling to ourselves, looking at the broader markets. Would you agree that any kind of stimulus should be focused towards assets that improve competitiveness?
Well, competitiveness is a complicated thing to measure. Anything that contributes to the costs of a company is affecting their competitiveness. Often economists point to the exchange rate as a key part of that. But of course, all forms of taxation or the costs of obtaining permits or lags in obtaining permits, the cost of electricity, which, as you may know, is much higher, for example, in Ontario than it is in Michigan, right next door. Those things are all the things that go in to affect competitiveness. Now, how can policymakers contribute? Well, competitiveness is usually driven by productivity. So anything that encourages new investment in digitalization or opportunities for automation. Yes, the tax structure matters. Infrastructure matters a great deal to Canada's competitiveness. And so there are things going on a wide range of fronts which should help us improve our competitiveness. Possibly the most urgent would be around the ability to digitalize. And so broadband internet and as well as the skill sets to go with that. But I'm sorry I'm giving you a vague answer, but that's because the question is such a wide-ranging one. I certainly agree that government should be using its tools in every way it can to facilitate companies' ability to improve their competitiveness. That's not necessarily the same as using stimulus dollars to buy things or make certain things happen. But infrastructure, as if I can use the term broadly enough, is for sure a facilitator of competitiveness.
Okay, we went substantially over there, but I think we need a full-scale answer. Turning to Mr. Fragiskatis, followed by Mr. St. Marie. Peter?
Thank you, Chair. Mr. Poloz, I'll continue with you as a matter of fact. I want to ask you about your specific impressions on Budget 2021. You were quoted in media recently, and this is what you said. The minimum ingredients that one needs to have in a sustainable plan are present, and that was done without a meaningful increase in taxes of any kind. Could you expand on that?
Sure. As I said in my opening remarks, if we just look at page 328 of the budget, you can see clearly there that that the forecast debt to national income ratio stops rising next year and is projected to decline very gradually from there. As I said in my opening remarks, that meets what I call the minimum or a technical definition of sustainability, which is that debt is not continuing to rise. Debt is actually slowing relative to your ability to service it. Debt service, public debt charges remain not much above 1% of national income, which for reference is around 1/5 of what they were in the mid-1990s, for example, when we hit a bit of a fiscal wall. So that's a positive way to put it. If you believe that it leaves us unequipped to deal with the next big shock that comes to the economy, that's a judgment, and I won't make that judgment today. But if you believe that, then you would probably argue for a faster decline in indebtedness over time. That's something for sort of the political process to work out, but it's not necessary to what I call the minimum requirements of sustainability.
Thank you very much for that. A lot of interesting things there, of course, in your testimony as well, but I have limited time. And again, I'd like to explore some things that you've said specifically about the budget, in particular in response to criticisms of it that suggest that this is leading to a massive expansion of the state. What you said in response to that criticism is that what I take a little bit of exception to is it's being cast, the budget that is, as this path-breaking move to big government. There is a conservatism around those numbers. What do you mean by that?
Well, as I indicated in my opening statement, again, the same table, page 328 of the budget, shows that once we get past the activities around COVID, Next year and in subsequent years, budgetary revenues settle down at about 15% of national income, which is the total tax take of the federal government and other fees. That's exactly what it was before COVID, and it's exactly how it was laid out in the 2019 budget. And if I look at program expenses, they too settle down to 15% of national income. And they were around 15% of national income before COVID and in the 2019 budget. Therefore, the government